The impact of inflation. We've got inflation. I'm sure some or all of you would have seen before you came on the webinar that the US CPI has just come out at 9.1%. Cue panic and so on. Here's an illustration of what we think is defensive about our portfolio and the sort of thing that we seek to avoid. Target, the US retailer, recently had its quarterly figures for Q1 2022 in its fiscal year, and you can see at the top there, sales grew by 4%, not bad actually. Gross margins slipped by 4.3% or 430 bips. Combination of things in terms of supply chain costs, increased costs in their warehousing operations, sale of fewer discretionary high margin items, the usual kind of raft of things that you might think would affect a retailer in inflation. The operating margin dropped by an extremely similar 450 basis points, so almost at the same number. And the net result was operating profits down by 43% and the stock down by 25%. And this is a pretty good retailer, by the way, in my view. I think Target is up there in terms of the top sort of handful at worst of retailers that I've ever looked at. Now, they haven't got the actual numbers yet for L'Oreal, so these, I'm afraid, are theoretical, but I think when we get the actual numbers, they'll be better than this. I've just assumed that the same thing happens to L'Oreal, and I'd be prepared to have a bet that something a lot better than this happens to L'Oreal. Sales up 4%. By the way, I think they'll beat that, so I'll take the same as Target. Gross margins down by 430 bips. I don't think there's any chance that the gross margin will go down by 430 bips. Operating margin down by 450 bips. Even if the gross margin did go down by 430 bips, I don't think the operating margin would go down by 450 bips because they've got such a large gap in between on which to operate on their cost base that I don't think that's too likely. But anyway, just assuming they don't manage to achieve anything better than the Target performance in terms of changes, the operating profit only falls 21%, about half the target level, for a very simple reason. You know, the gross margin is a lot higher. They're making things for 26 and selling them for 100. Our friends at Target are buying things in for 70 and selling them for 100. It's a much better position to be in. And if you look at the look-through table that we did there and just average it and take the same calculation, sales from 100 to 104, 4%. Gross margin, you can see, down by 430 bips to 59.7%. Operating margin, 450 bips. Total fall, 14%. We've got some pretty high margin businesses in there. Not only our cosmetics businesses, but also our software businesses are very high margin businesses. And this is the first line of defense in terms of inflation. I mean, I've been through inflationary periods earlier in my career, and I know what they feel and look like. You know, you might not be very happy if you've got 14% profit fall. I'm not, but you'd be an awful lot happier than 43%. That's for sure. And you know, we are in a situation. We had the first numbers out of the earnings season yesterday for PepsiCo, which is one of our holdings. Sales are up 13%, and 12% of that was from price. Now, I'm not very happy about that because I like people to sell more of something. You know, there's an old sort of calculation or line which goes, you know, if you own a Pepsi share for $1 and it goes to $1.15, and at the same time a can of Pepsi goes from $1 to $1.15, you might feel richer, but you're not any richer because you haven't made any real money with which to pay for the can of Pepsi. And so, you know, that's kind of not good, but it's better than the alternative. I mean, in circumstances such as we now face, somebody who can put up their prices by 12% and still generate 1% volume growth is quite a defensive stock in relative terms in relation to the remainder of the world. TINA, an acronym that you may or may not come across, and I've sort of touched upon it there. We're in an inflationary period. I've got no great crystal ball into how long or how bad it will be. I mean, I'm not optimistic, but then I really am optimistic, actually, as my colleagues will tell you. But I think there's a chance that, given that it appears to have been born not by excessive demand, but by supply chain disruption and incorrect monetary policy, that it could disappear as rapidly as it appeared. In fact, one of the great theories of life is that monetary policy is always either too lax or too tight, and it definitely was too lax. And of course, what we may find in a relatively short space of time, if the supply chain begins to correct and demand does drop as a result of rising interest rates, is it's then become too tight. But what I do know is this: in periods such as this, whilst owning something like Pepsi, which we do, isn't great because 1% volume growth isn't terrific. It's actually better than owning most other things. You're owning bonds in this period is not great. Fairly obviously, owning cash is even worse. I mean, last time I had a look, I could go and buy a short-term bond on a yield of about 2.2 to 2.4% in the US to park my money in. With inflation running at 9%, that's not a great trade. Basically. So as much as this may be a very painful period, it may be that we're in the best alternative there is out there.